You know that iconic red and orange interlocking circle logo?
Oh yeah, you see it everywhere.
It's ubiquitous, isn't it? From the physical card nestled in your wallet to the seamless tap on your phone at a coffee shop, or maybe the digital checkout of your favorite online store.
We interact with it constantly.
Almost unconsciously every single day. But have you ever paused to consider what that Mastercard logo truly represents beyond just a piece of plastic or a digital tap?
Right. What's really behind it?
Is it merely a payment processor, a simple intermediary, or is it something far more expansive, maybe a foundational, almost invisible layer underpinning vast swaths of global commerce?
That's a great question.
Today, we're taking a deep dive into Mastercard, ticker symbol MA. We're going to dissect its latest Q2 2025 earnings report, peel back the layers of its underlying business model to truly understand its genius, examine its powerful growth drivers that continue to propel it forward, and explore how it's not just navigating, but actively shaping a rapidly evolving financial landscape.
And we've got some great material to work with.
Yeah. To do this, we've pulled together insights from its own comprehensive Q2 2025 earnings presentations and press releases, alongside expert analyses from highly respected sources like Cosmic Capital, Linus's newsletter, Renberg Invest Insights, and dividend data.
And our mission today, for you, our discerning listener, is really to cut through all the financial jargon and market noise.
Get straight to the point.
Exactly. We want to equip you with a truly comprehensive understanding of Mastercard's operational excellence, its strategic positioning in the dynamic global economy, and its remarkable future potential.
Okay.
You'll discover precisely why so many analysts and investors consistently hail it as a compounding machine and a virtually impenetrable fortress in the financial world.
But we're not just going to paint a rosy picture.
No, absolutely not. We won't shy away from examining the very real challenges it faces, ensuring you get to those core insights that genuinely matter, giving you a well-rounded perspective.
And trust me, we have some truly eye-opening facts awaiting you. Imagine a company as dominant as Mastercard, already processing trillions in transactions.
Which is hard to even fathom.
Right. Still having an absolutely massive and largely untapped transaction runway ahead of it. Or consider how this company, rather than being, disrupted by emerging technologies, is ingeniously turning perceived threats, like the rise of stablecoins,
Which everyone talks about.
into entirely new avenues for growth and revenue. Get ready to fundamentally rethink what you thought you knew about your humble payment card, because the story behind those interlocking circles is far more intricate and compelling than you might suspect.
Definitely.
Yeah?
Mastercard's enduring business model, the digital payment network.
Let's begin with the absolute fundamentals, because sometimes the simplest explanations unlock the most profound understanding.
Good place to start.
At its heart, Mastercard operates what we refer to as a digital payment network. Now, that might sound straightforward.
But it's incredibly complex.
Exactly. It's actually the silent, incredibly complex engine that authorizes, clears, and settles countless transactions every second across the globe. Think of it less as a simple pipe and more as a sophisticated real-time message router.
Right.
Every time you swipe, tap, or click with a Mastercard-branded card, their network is authenticating the cardholder, authorizing the transaction with the issuing bank, and then clearing the payment to the acquiring bank.
All in milliseconds usual.
All typically within milliseconds. They are, quite literally, the rails upon which digital money moves, ensuring trust and speed in every digital exchange.
And this leads us to a crucial distinction, one that is fundamental to understanding the remarkable de-risking of their entire core business model.
Okay, what's that?
Mastercard itself does not issue the cards you hold.
Right. The bank does.
Exactly. They aren't the bank that extends you credit or provides your debit account. Crucially, they do not bear any direct credit risk or fraud risk associated with those individual transactions.
That's huge.
It is. Instead, their role is that of a trusted partner, working in collaboration with thousands of financial institutions and innovative fintech companies worldwide.
So they enable others.
Precisely. These partners are the ones who issue the cards, manage the customer relationships, and assume the credit risk. This partnership-driven asset-light model is a cornerstone of their incredible efficiency and resilience, allowing them to focus purely on the integrity and speed of their network.
That's a powerful point. So, to build on your analogy, if we were to visualize this, it's not as if MasterCard owns all the cars driving on the road, nor are they the ones providing the fuel.
Good analogy.
Instead, they've meticulously designed, built, and continuously maintained an invisible, secure, and incredibly efficient highway system for money.
Mm-hmm.
And on every single journey that money takes, every single transaction that traverses their robust network, they collect a very small, yet remarkably consistent and predictable toll.
A tiny slice of a huge pie.
Exactly. It's an ingenious, highly scalable model for capturing immense value from virtually every digital exchange around the globe without taking on the direct financial risks typically associated with lending or direct consumer relationships.
Precisely. This elegant model has propelled Mastercard into a truly remarkable and strategic market position. It operates within what our sources consistently describe as a nearly impenetrable duopoly, alongside its closest peer, Visa.
The two giants.
Right. Together, these two giants effectively account for approximately 90% of all digital payment processing that occurs outside of China.
90%, wow.
This isn't merely a statistic about market share. It speaks to their foundational, almost indispensable role in the global financial infrastructure. This level of dominance isn't easily achieved or dislodged.
And the sheer scale of their operation is genuinely mind-boggling. According to the insights from Reinberg Invest Insights, MasterCard alone processes about 25% of all global general-purpose card transactions.
A quarter of the world's card payments.
To put that into perspective, we're talking about an astounding $9 trillion in annual transaction value flowing across their network,
$9 trillion.
facilitating 143 billion individual transactions annually. This incredible volume is supported by over 3.3 billion active MasterCard-branded cards in circulation as of 2023.
That's almost one card for every 2 adults on the planet, roughly.
These aren't just abstract, large numbers. They represent the daily, fundamental reliance that billions of consumers and millions of businesses place on MasterCard's infrastructure. It's no wonder they're consistently ranked as the 39th most valuable brand globally, surpassing well-known names like PayPal and Airbnb.
And this leads us to what many analysts refer to as Mastercard's impenetrable moat.
Right, the competitive advantage.
Exactly. This isn't a physical barrier, but a powerful competitive advantage built on several interconnected factors. First, there's the massive network effect. The more users their network attracts, the more merchants feel compelled to accept Mastercard, which in turn attracts even more users.
A virtuous cycle.
It's a classic virtuous cycle, creating immense stickiness. Second, there's the profound trust that billions of consumers, businesses, and governments place in their brand, a trust painstakingly built over decades through consistent reliability and security.
That trust is hard-earned.
Incredibly hard-earned. Finally, there's the sheer global acceptance of their cards. Replicating a network of this size, with this level of trust and this ubiquitous acceptance, is an undertaking that would require truly astronomical capital investment, decades of regulatory navigation, and an almost impossible feat of overcoming entrenched habit.
So, new entrants face a massive uphill battle.
A monumental one. This makes their position remarkably secure. 2. Shining a light on Q2 2025, the latest performance snapshot.
All right, now that we've firmly established MasterCard's foundational business model, let's put some fresh, concrete numbers on the table from their latest performance.
Let's get into the Q2 results.
MasterCard reported its Q2 2025 results on July 31st, 2025, and the headline was certainly strong. Net revenue grew a robust 17% year over year, soaring to an impressive $8.1 billion.
17% growth is quite something at their scale.
Yeah, and even when we adjust for currency fluctuations, that's still a solid 16% growth, with about a 1 percentage point increase coming from strategic acquisitions. So right out of the gate, you can see significant top-line momentum, indicating a very healthy and expanding business.
And this isn't just a fleeting good quarter, which is a crucial distinction. Cosmic Capital specifically highlights that this strong outperformance continues what they describe as an enviable track record of consistent compounding.
Just keep delivering.
They really do. Mastercard has, with remarkable consistency, not only met but often surpassed analyst expectations, demonstrating a reliable growth engine. This robust growth wasn't narrow or confined to a single area. It was broadly driven by the strength of both its core payment network functions and its rapidly expanding suite of higher-margin value-added services.
We'll definitely need to unpack those value-added services later.
Absolutely. This diversified growth profile points to a very healthy and strategically sound business.
And that strength didn't stop at the top line. Let's delve into the bottom line. Earnings per share.
Always important.
Their diluted EPS grew 16% to $4.07 on a GAAP basis, which stands for Generally Accepted Accounting Principles.
Mm-hmm.
If we look at the adjusted diluted EPS, which removes certain one-time items, it was up 16% to $4.15, or 14% on a currency-neutral basis.
So strong profit growth matching the revenue growth.
Very healthy increases, especially when you consider the scale of the company and the broader economic environment. It shows they're not just growing revenue, but efficiently converting it into profit for shareholders.
This naturally leads us to ask, how exactly are they achieving this level of bottom-line growth? It points directly to strong operating leverage.
Meaning they're becoming more efficient as they scale.
Exactly. Operating income, a key measure of a company's core profitability before taxes, increased a remarkable 18% to $4.8 billion. This expansion allowed them to increase their adjusted operating margin by a solid 0.5 percentage points, reaching an extremely healthy 59.9%.
Almost 60% operating margin. That's incredible.
It really is. Now, it's worth noting an increase in their effective tax rate, which went from 17.3% to 20.8% on a GAAP basis, and from 17.5% to 20.9% adjusted.
Okay, why the jump in tax rate?
This was primarily due to the implementation of the 15% global minimum tax, known as the OECD's Pillar 2 rules, in various jurisdictions like Singapore, which came into effect in 2025.
Ah, the global minimum tax kicking in.
Right. These rules aim to ensure large multinational corporations pay a minimum effective tax rate globally. Despite this new tax headwind, the underlying operational efficiency clearly shone through, demonstrating strong cost control and scale benefits.
Diving even deeper into the core operational metrics for Q2 2025, the key business drivers reveal a lot about how money is actively moving across their network.
The engine room stat.
Exactly. Gross dollar volume, or GDV, which represents the dollar value of transactions processed, was up a healthy 9% year-over-year worldwide on a local currency basis.
Solid growth globally.
Breaking that down further, we saw 6% growth in the United States and an even stronger 10% internationally, highlighting their global momentum.
International continues to be a key driver.
Critically, cross-border volume, which is a higher margin revenue stream for them because it involves currency conversion and often higher fees, jumped an impressive 15% year-over-year.
15%, that's very strong.
Indicating robust international travel and trade, the sheer number of switched transactions, meaning the total count of transactions processed directly by Mastercard's network, was up 10%.
More people tapping and swiping more often.
And finally, a key indicator of their expanding reach. The number of Mastercard and Maestro branded cards issued globally grew 6% year-over-year, reaching 3.6 billion active cards as of June 30, 2025.
3.6 billion cards out there. That's an astonishing amount of both physical and virtual plastic in people's hands worldwide.
It really is.
These robust figures collectively paint a compelling picture of resilient consumer spending and a continued global economic recovery, which serve as powerful macro tailwinds for Mastercard.
So the overall economy helps, but it's not the whole story.
Not at all. Beyond these broad trends, a significant driver of their growth stems from strategic deal wins. Just in this past quarter, they secured crucial extensions of exclusive partnerships, such as with American Airlines, which brings continued volume through travel.
Locking in key partners.
Right. They also forged new partnerships with innovative fintech companies like PaySend, Leap Financial, and Felix Pago in the dynamic Latin American market, expanding their reach into new digital payment flows.
Tapping into that fintech growth.
Exactly. Furthermore, they renewed key deals with major institutions like Brussels Airlines and large financial players such as BNP Paribas and Doha Bank. These partnerships are absolutely crucial for expanding their network's footprint, securing future transaction volumes, and maintaining their competitive edge in key markets.
To give us a little more context and a truly holistic view, let's do a quick qualitative and quantitative comparison between Mastercard and its closest peer, Visa.
Always a useful comparison.
Dividend data touched on their prior Q2 2024 results, and it's interesting to see how Mastercard stacked up then, as these trends often persist.
Okay, what did that show?
In that particular period, Mastercard showed stronger non-GAAP metrics, with adjusted net income up 22% compared to Visa's 9%, and adjusted EPS up 24% versus Visa's 12%.
So significantly faster bottom-line growth for Mastercard in that snapshot.
Right. Both companies saw similar revenue growth in that quarter, hovering around 10–11%. But a notable point was that Mastercard showed less deceleration in its growth compared to Visa during that specific period.
Interesting. If we connect this to the broader competitive landscape and investor perception, while Visa had an objectively stronger balance sheet in Q2 2024, holding $19.5 billion in cash compared to Mastercard's $7 billion and only $1 billion in net debt versus Mastercard's $8.61 billion.
So Visa looks safer on paper, maybe.
From a pure balance sheet perspective, perhaps, but Mastercard often commands a persistently higher trading multiple from the market. For instance, in Q2 2024, Mastercard's PE ratio was 36.8 compared to Visa's 27.
Why the premium for Mastercard then?
This premium is typically attributed by analysts to Mastercard's historically faster growth rates and strong analyst projections for continued superior growth into the future. It speaks to investor confidence not just in the current performance, but in Mastercard's perceived ability to accelerate and maintain its growth trajectory over the long term.
Maybe because of things like those value-added services.
That's likely part of it, yeah. Perhaps due to its diversified revenue streams and strategic agility. This signals that the market places a higher value on Mastercard's growth potential and strategic positioning, even with a slightly different financial structure. 3. The long runway ahead. Sustaining growth in a digital world.
Now here's where the story of Mastercard's future gets genuinely intriguing and perhaps a bit counterintuitive.
Okay, I'm listening.
Despite how deeply integrated card usage feels in our daily lives, a surprisingly significant portion of transactions globally are still conducted using cash and checks.
It's easy to forget that in our digital bubbles.
Totally. We're not talking solely about remote, underdeveloped villages. Even in highly developed economies, there remains an enormous latent potential for digital payments to expand further. This isn't just about market share, but about expanding the entire pie.
This brings us to a crucial concept often discussed by our sources, the transaction runway.
Explain that a bit more.
Let me give you some compelling data to illustrate just how vast this runway is. Globally, Mastercard's average transactions per card stand at about 60 per year, which, if you break it down, is only around 5 transactions per month.
Only 5 times a month? That seems really low.
It does, right? Now consider Australia, a country with exceptionally high card penetration and digital adoption. There, debit card transactions alone reached an astonishing 650 annually per person in 2022.
650?
A figure that has more than doubled in just a decade. That stark difference, 5 transactions per month globally versus over 50 per month in a highly digitized market, powerfully illustrates the immense room there is for transaction frequency to grow, even in seemingly mature markets.
So people could theoretically use their cards 10 times more often?
Potentially, yes. Think about it. In Europe, for example, roughly 52% of all retail transactions are still conducted using cash. This is a massive segment waiting to go digital.
That's a truly staggering difference, highlighting the sheer scale of this latent runway for growth. Greenberg Invest Insights forecasts that the total digital transaction value globally is expected to grow at a compound annual growth rate, or CAGR, of about 16% through 2029.
16% CAGR is a huge tailwind.
That's not a short-term trend. That's a massive, sustained tailwind for a company like Mastercard, which is uniquely and perfectly positioned to capture that ongoing shift from physical to digital cash. It's a structural transformation in how the world handles money, and Mastercard is at its very epicenter.
And to actively accelerate this monumental shift towards digital, Mastercard is relentlessly focused on reducing friction in payment processes.
Making it easier to ditch cash.
Exactly. This isn't just a buzzword, it's a strategic imperative. The goal is to make digital payments so effortlessly seamless, so inherently convenient, and so universally accessible that choosing traditional cash or checks becomes genuinely inconvenient or even obsolete for everyday transactions.
Yeah.
By systematically removing barriers, they're expanding their transaction volume significantly, encouraging habitual digital payment use.
And they're doing this with some truly tangible and impactful innovations. Let's look at a few examples.
Okay.
Tap to Pay. This technology, familiar to many, completely eliminates the need for PINs or signatures for many transactions, especially smaller ones. This dramatically speeds up checkout times.
It's a huge difference in queues.
Transforming the user experience from a minor inconvenience into a swift, effortless action.
Then there's digital wallets.
Right. These are rapidly becoming the norm. Mastercard enables payments directly through your phone or wearable device using virtual cards. We've seen this through their extended partnership with PayPal, allowing PayPal users to leverage Mastercard's network more broadly, and their launch of contactless wallets in Germany, expanding reach into new markets.
And tokenization is a big one, too.
Explain that. It sounds technical, but it's important, right?
It's a groundbreaking security innovation. Instead of transmitting your actual 16-digit card number, Tokenization replaces it with a unique, single-use digital token for each transaction.
So your real number isn't exposed online.
Precisely. This dramatically reduces the risk of fraud, especially for online shopping, and significantly boosts authorization rates. Mastercard is so committed to this that they plan to move entirely to tokenization and on-card biometrics by 2030,
By 2030.
aiming to eliminate the manual entry of card numbers and passwords for online shopping altogether and tackle online fraud, which is currently a staggering 7 times higher than in physical stores.
Imagine the impact on consumer confidence. That's huge.
Absolutely. And then there's Tap on Phone.
This one's cool for small businesses.
Yeah, this innovation empowers small businesses. It allows merchants to accept card payments directly on their own smartphones without needing additional hardware like card readers. This drastically increases the number of acceptance points, especially for micro merchants and informal businesses, expanding Mastercard's network at the grassroots level.
Getting cards accepted literally anywhere.
That's the goal. And finally, transit payments.
Like tapping onto the subway?
Exactly. By integrating card payments into public transport systems, allowing you to simply tap your card or phone to pay for a bus or train ride, Mastercard fosters habitual card usage in daily routines. This makes digital payments the default choice for millions, replacing what were historically cash-heavy transactions.
Makes perfect sense.
These innovations are absolutely critical because they collectively make card payments not just faster and more secure, but also infinitely more accessible and convenient on a global scale.
Reducing that friction.
By consistently identifying and reducing points of friction, Mastercard is driving habitual use for an ever wider range of transactions, from that morning coffee to your daily commute, and particularly for those smaller, everyday purchases that traditionally would have been handled exclusively with cash. This creates a powerful, ingrained behavior that benefits their network with every single tap.
Okay, let's unpack this next segment because it's a critical and often overlooked growth driver that speaks volumes about Mastercard's forward strategy, value-added services, or VAS.
Right, this is a really important part of the story now.
These services saw genuinely impressive revenue growth in Q2 2025, up a robust 23% or 22% on a currency-neutral basis.
23% growth is huge.
A significant 4 percentage points of that growth did come from strategic acquisitions, but even stripping that out, the organic growth in this segment is incredibly strong, demonstrating inherent demand.
This is a fascinating area because it showcases Mastercard's evolution beyond just being a transaction toll collector. These services are incredibly diverse and sophisticated.
So what do they actually include?
They encompass everything from advanced fraud detection and prevention tools that protect both consumers and merchants, to robust cybersecurity solutions for financial institutions, and innovative authentication technologies that enhance trust in every digital interaction. They also offer sophisticated data analytics and insight services.
Ah, the data piece.
Exactly. These aren't merely ancillary offerings, they are powerful, mission-critical, and highly in-demand solutions that businesses need to navigate the complexities and risks of the digital economy.
And this is where the saying, data is the new gold, truly comes alive. Mastercard sits on a treasure trove of an astounding 15 petabytes of payment data.
15 petabytes. That's an unimaginable amount of information.
This isn't just raw, undifferentiated numbers. It's a rich tapestry of granular insights into consumer behavior, emerging market trends, and operational efficiency across virtually every industry and geography.
So businesses can use this data.
Right. This vast pool of data is absolutely crucial for strategic decision-making, not just for financial institutions, but for retailers, e-commerce giants, and even governments looking to understand economic patterns. Imagine having that level of sophisticated real-time intelligence at your fingertips to inform business strategy and risk management.
This raises an important question. Why does this diversification into value-added services matter so much for Mastercard's overall health and future?
Good question. Why?
It provides a significant and strategic diversification benefit. These services now account for about 38% of Mastercard's total revenue, a notable increase from 35% in 2020, showing a deliberate shift.
Almost 40% of revenue now.
Getting close. Crucially, a large portion of these revenues are recurring and subscription-based, which makes Mastercard less exposed to the cyclical ebbs and flows of the broader economy compared to its core transaction revenues.
So it makes their earnings more stable.
Exactly. It creates a more stable, predictable revenue stream. Management sees an enormous total addressable market, or TAM, of $490 billion for these services globally,
$500 billion almost.
with a serviceable addressable market, or SAM, of $165 billion that Mastercard is directly targeting. Currently, Mastercard captures only about 7% of its TAM,
Only 7%.
indicating a truly vast, largely untapped growth opportunity that they are actively pursuing through both organic innovation and strategic acquisitions.
Building on that theme of expanding reach and diversification, let's talk about Mastercard's global footprint. It's a very significant strategic advantage.
Definitely plays a big role.
A substantial 66% of its business is international, meaning outside the United States. This gives it considerably more global exposure compared to its peer Visa, which has approximately 56% of its business originating from non-U.S. markets.
So Mastercard is more globally diversified.
Right.
This geographic diversification is incredibly beneficial, particularly for long-term growth. It means Mastercard is less dependent on the often slower-growing, more mature Western or developed regions.
Less reliance on the U.S. and Europe, relatively speaking.
Correct. In fact, their dependence on these regions has steadily decreased, falling from 70% in 2020 to 67% in 2024. This strategic weighting allows Mastercard to capture faster growth in dynamic emerging markets, where digital adoption is still significantly underdeveloped but rapidly accelerating.
Makes sense. Go where the growth is fastest.
Precisely. Furthermore, cross-border travel, which generates higher-value revenue streams for Mastercard due to foreign exchange fees and increased transaction volumes, continues to grow strongly, showing a robust 15% increase in Q2 2025 alone.
We saw that earlier, yeah.
This extensive international footprint isn't just about presence. It's a vital, high-growth engine within their long-term strategic narrative.
4. Navigating the headwinds, challenges, and strategic responses. Now, despite its formidable competitive position and impressive growth, it's crucial to acknowledge that Mastercard operates in a highly scrutinized environment and is not immune to challenges.
Right. No company is perfect. What are the main headwinds?
Yeah.
The company consistently faces what our sources aptly describe as regulatory headwinds. What's particularly insightful here is that the consensus among analysts suggests that the primary problems the company might encounter often stem from external government regulation, rather than any fundamental weakness in the business realities of its fantastic asset-light model.
So the business itself is sound, but governments could interfere.
That's the general view, yes. This distinction is vital for understanding the true nature of their challenges.
That's a really critical distinction, isn't it? The sources highlight several specific and ongoing areas of concern. We're talking about intensifying regulatory scrutiny that can manifest in various forms.
Like interchange fee caps or antitrust probes.
Exactly. Potential competitive disruption from fintech and government-backed payment systems that seek to create alternative rails, and the natural maturation of developed market penetration, meaning less low-hanging fruit for growth in established regions.
Growth naturally slows in mature markets.
You can even see the tangible impact of this regulatory environment in their Q2 2025 earnings report, where litigation provisions were a notable operating expense, with $96 million primarily due to a legal provision associated with ongoing complaints about the ATM non-discrimination rule surcharge.
So legal costs are a factor.
This rule aims to ensure that surcharges applied by ATM operators are fair and non-discriminatory, but it highlights the constant legal and regulatory battles they navigate. So while the core business is incredibly robust, they definitely have to keep a constant, vigilant watch on the policy and legal fronts, which can introduce uncertainty and costs.
It's part of the cost of doing business at their scale.
Now, this might sound genuinely counterintuitive given the common narrative around disruption, but here's where Mastercard's strategic agility becomes incredibly evident.
Okay.
Even disruptive new technologies, often initially perceived as existential threats to traditional payment networks, have actually been beneficial for Mastercard's overall transaction growth.
Interesting. So disruption isn't always bad for them.
Apparently not.
This is a prime example of their strategic adaptability and foresight. Mastercard doesn't just react to emerging trends. It proactively seeks to partner with them, effectively transforming potential threats into powerful new growth opportunities.
Turning lemons into lemonade, so to speak.
Pretty much. They understand that if a new technology gains traction, it's often more advantageous to integrate and enable it rather than to resist it.
Can you give us some concrete examples of how they've operationalized that proactive partnering, particularly with innovations that might have initially seemed to bypass traditional card networks?
Absolutely. Take Buy Now, Pay Later, or BNPL, which initially seemed like a way to circumvent card networks by offering direct installment payments.
Right, that looked like a direct competitor.
It did. But instead of being disintermediated, Mastercard offers specialized cards for in-store BNPL payments, provides white-label products and infrastructure for BNPL providers, and facilitates the card repayments for those loans.
So they're still involved in the transaction flow.
They're effectively embedding themselves as the underlying payment rails for the BNPL ecosystem, ensuring that even deferred payments still eventually touch their network.
Yeah.
Similarly, with the explosion of digital wallets, which aggregate various payment methods.
Like Apple Pay or Google Pay.
Exactly. Mastercard provides digital wallet providers with the secure and scalable infrastructure to operate. They enable these wallets to issue virtual cards that leverage Mastercard's global network. We've seen this vividly with their extended partnership with PayPal, allowing PayPal to scale its offerings, and their direct involvement in the launch of a contactless mobile wallet in Germany, expanding their reach through new digital channels.
So what does this all truly mean for you, the listener, and for Mastercard's long-term strategy?
What's the takeaway?
It means Mastercard leverages its massive, scaled, and trusted network to become an enabler for these new technologies. Rather than perceiving innovation as a zero-sum game, they embrace it.
If you can't beat them, join them
Yeah.
and enable them.
Exactly. By making it easier and more secure for these new services to operate, they lead to faster adoption, broader usage, and ultimately greater monetization for Mastercard itself. It's a very clever symbiotic strategy that ensures they remain central to the evolving payment landscape.
Makes sense.
Now let's turn our attention to one of the latest disruptors that has been making significant headlines, especially in financial tech circles, stablecoins.
Ah, yes, the crypto connection.
These digital currencies, designed to maintain a stable value relative to a fiat currency like the US dollar, are often touted as a payment method that could finally disintermediate the traditional card networks by offering direct peer-to-peer digital transactions. Is this the real looming threat to Mastercard's fortress-like position?
Well, if we connect this to the broader picture and the nuanced view from our sources, the consensus suggests that, for now, stablecoins primarily serve very niche use cases.
Like what?
Their main application remains funding crypto-related trading on exchanges, which is not directly competitive with everyday retail payments.
So not for buying groceries yet.
Not really, no. Visa shares this perspective, identifying the primary product-market fit for stablecoins mainly in emerging markets, where local fiat currencies are highly volatile or access to stable USD is limited, and for certain specific cross-border money movements, particularly in the realm of B2B payments and remittances.
So specific problems in specific places.
Right. Critically, we're not yet seeing widespread habitual adoption of stablecoins for everyday consumer purchases at your local grocery store or online retailer.
What's holding them back from wider use?
What's truly crucial here is that Mastercard itself very clearly highlights its numerous, well-established advantages over stablecoins that currently make traditional card payments far superior for the vast majority of consumers and merchants.
Okay, like what advantages?
These advantages include a truly seamless and predictable user experience that requires no technical expertise, unparalleled global reach and acceptance at millions of merchant locations worldwide, consistently high conversion rates, and critically multi-layered security protocols against fraud that have been honed over decades.
Things we take for granted with cards.
Exactly. Furthermore, Mastercard offers robust compliance with local and international financial regulations, proven reliability and uptime, and essential consumer protections like chargebacks and zero liability policies that are simply not yet mature in the stablecoin ecosystem.
So cards are just easier, safer, and more accepted for now.
Pretty much. These attributes are why Mastercard is trusted by billions across 150 currencies in 220 countries and territories, providing a level of confidence and convenience that stablecoins are far from matching in the mainstream.
So given these inherent advantages of traditional card networks, how does Mastercard envision itself benefiting from stablecoins rather than being disintermediated by them? What's their strategic approach to this emerging technology?
Again, it comes back to enabling. Mastercard has identified 3 key pragmatic ways it can capitalize on this trend, further cementing its role as an enabler rather than a competitor.
Okay, what are the 3 ways?
Firstly, by facilitating card payments to fund on- and off-ramp stablecoin transactions. Essentially, they position themselves as the secure, reliable bridge between the traditional financial system and the crypto world, making it easy for users to convert fiat to stablecoins and vice versa.
So using Mastercard to buy or sell stablecoins.
Exactly. Secondly, by enabling partners in the stablecoin space with their existing suite of value-added services like zero liability protection, advanced fraud detection, and even rewards programs for stablecoin wallets. They bring their deep expertise and established trust to new players.
Lending their infrastructure and security.
Right. And thirdly, by addressing specific niche use cases in commercial and cross-border payments, where stablecoins might offer a particular efficiency advantage, ensuring they are part of those new specialized payment flows.
Playing in the areas where stablecoins actually make sense today.
Precisely. However, this raises an important long-term question. What about the truly disruptive, albeit low-probability, threat?
The what-if scenario.
While not a current concern, a potential major disruption could occur if, for instance, a mega cap like Amazon were to launch its own widely adopted stablecoin and somehow manage to scale its adoption to replace traditional payments within its vast ecosystem.
That would be a game changer.
It would present a genuine challenge. But for now, the inherent high costs associated with buying and selling stablecoins, coupled with their limited consumer value proposition for everyday retail transactions, they don't currently offer rewards or the same fraud protection as cards, for example, strongly suggest that, much like BNPL and digital wallets, stablecoins will likely solve specific niche use cases.
And Mastercard plans to be part of those niches.
And in those niches, Mastercard is actively working to be a key enabling partner, ensuring they remain relevant and profitable within this evolving space. They are watching the developments closely, but are incredibly well positioned to adapt, as their track record shows. V Financial Fortitude and Shareholder Value.
Let's shift gears now to discuss Mastercard's financial profile, which is consistently described by analysts as one of the best in the world.
It really is impressive financially.
We're talking about a company that isn't just growing, but is an absolute financial powerhouse, demonstrating remarkable efficiency and profitability.
That's an accurate assessment. The margins are simply exceptional and speak volumes about their highly efficient, asset-light business model.
How exceptional are we talking?
We're looking at 76% gross margins, an incredible 57% operating margins, and a robust 44% net margins based on earlier 2024 data.
Wow, those are high.
Extremely high.
Yeah.
And as we just discussed, for Q2 2025, their adjusted operating margin was an extremely healthy 59.9%. These figures are not just numbers. They represent an incredibly lean, efficient, and profitable operation that scales with minimal additional cost.
So more revenue drops quickly to the bottom line.
A significant portion drops straight to the bottom line, yes.
And here's where it gets particularly insightful and truly highlights their extreme efficiency compared to peers. Mastercard consistently delivers an exceptional return on capital employed, or ROCE.
ROCE, a key metric.
It's currently sitting at an impressive 58%, according to Reinberg and Vet Insights, or around 55% from dividend data. To put that into stark perspective, that's almost double that of its closest competitor, Visa, which typically shows an ROCE of around 30%.
Double Visa's ROCE. How did they achieve that?
This isn't merely a good number. It's a clear and powerful indicator of how incredibly effective Mastercard is at generating substantial profit from the capital it deploys within its business. It speaks to a fundamentally different operational and capital allocation strategy.
Indeed. That significant difference in ROCE points to how Mastercard has engineered its business model to be incredibly capital efficient.
The asset-light model again.
Exactly. Unlike some companies that might need to invest heavily in physical assets or direct infrastructure, Mastercard leverages its network model and partnerships extensively. They don't own the cards, they don't bear the credit risk, and while they invest significantly in technology, their overall capital outlay relative to their revenue and profit generation is remarkably low.
Less capital tied up means higher returns on that capital.
Precisely. This asset-light approach, combined with stringent cost management and the immense operating leverage of their network, allows them to achieve nearly double the capital efficiency of their closest peer. This structural advantage is a core reason for its fortress status and its ability to compound capital so effectively for shareholders.
This high profitability and capital efficiency directly translate into a significant capacity to return capital to its shareholders. Mastercard truly operates as a free cash flow machine,
generating tons of cash.
In Q2 2025 alone, the company aggressively repurchased 4.2 million of its own shares at a cost of $2.3 billion.
Taking shares off the market, boosting EPS?
Exactly. This is a substantial reduction in the outstanding share count, which directly helps boost earnings per share for remaining shareholders. Additionally, they paid out a healthy $691 million in dividends to shareholders, providing direct cash returns.
So both buybacks and dividends. And looking at the broader historical picture, their commitment to shareholder value is undeniable. Since its 2006 IPO, management has returned a staggering $83 billion to shareholders through a combination of consistent share buybacks and a growing dividend.
$83 billion since the IPO. That's massive.
It is. They've effectively retired 30% of their outstanding shares since 2010, which has been a very significant contributor to their impressive EPS growth over that period.
Buybacks really fuel that EPS growth.
They certainly help. The board recently authorized another impressive $12 billion buyback program, signaling continued confidence in their ability to generate robust free cash flow and efficiently return that capital to shareholders.
The dividend itself, while often overshadowed by the growth story, is a testament to their financial strength and sustainability.
It's growing fast, right?
It's truly a fast-growing quarterly dividend, boasting an impressive 5-year compound annual growth rate of 14.87%, with the most recent increase at an even higher 15.79%.
Nearly 16% dividend growth recently. That's strong.
While the starting yield might appear low, typically around 0.50–0.58% due to the company's persistently high valuation.
Because the stock price is high.
Right. It's considered extremely sustainable by analysts. This sustainability is powerfully underscored by a remarkably low payout ratio, just 18% of free cash flow and 19% of earnings per share.
Wow, paying out less than 20% of earnings as dividends.
This leaves them with immense financial flexibility for continued investment in growth initiatives, strategic acquisitions, and further shareholder returns, making it a reliable and rapidly growing income stream within a growth portfolio.
Lots of room to keep growing that dividend.
And finally, a quick but crucial note on the health of their balance sheet, which provides a rock-solid foundation for all this growth and shareholder value creation.
How does the balance sheet look?
Mastercard holds approximately $11.5 billion in total cash against a total debt of $18.4 billion, based on Q3 2024 figures from Rinberg. As of Q2 2025, their cash and cash equivalents stood at $9.031 billion.
So manageable debt levels given their cash flow.
Yes, this strong cash position, combined with their robust cash flow generation, earns them an impressive A+ credit rating from major agencies, underscoring their exceptional financial stability and their ability to weather economic downturns or pursue strategic opportunities. 6. The road ahead, outlook and valuation.
Looking ahead, Mastercard's management has provided a clear and confident medium-term guidance extending through 2027.
What are they expecting?
They project continued revenue growth at a low to mid-double-digit rate, and even more impressively, diluted EPS growth at a mid-teens percentage.
Mid-teens EPS growth consistently.
That's the target. All of this while steadfastly maintaining an operating margin target of at least 55%. This guidance reflects a strong, confident outlook based on the resilience of their market position, the ongoing tailwinds of digital payments, and their effective execution on diverse growth drivers we've discussed.
And these projections aren't just internal corporate optimism. Independent analyst projections for EPS growth align quite well with management's outlook.
What are the analysts saying?
They forecast robust growth of 13% in 2024, followed by 15% in 2025, 16% in 2026, and an accelerating 17% in 2027.
So analysts see that mid-teens growth is achievable too.
These are widely considered reasonable and achievable estimates, given the company's strong historical performance, the persistent shift to digital payments, and its strategic initiatives we've detailed today. It speaks to a belief in sustained momentum.
Now, this naturally raises an important question for many discerning investors. What about the valuation?
Right, the price you pay. It always seems expensive.
Mastercard consistently trades at a premium to the broader market, often to its closest peer. For instance, in Q2 2024, its PE ratio was 36.8 compared to Visa's 27. More recently, Cosmic Capital noted a forward PE of 32x in August 2025, and Reinberg Invest Insights highlighted 36.5x this year's earnings in January 2025.
So yeah, definitely a premium multiple.
It is. But this premium, while seemingly high, is widely considered deserved due to its high growth rates and significant future potential. The market clearly recognizes the quality, resilience, and unique competitive advantages of this business, valuing its predictable, high-margin, compounding growth.
Quality commands a price, basically.
That seems to be the market's view.
So what does all this detailed analysis mean for you as you consider Mastercard's place in your understanding of the financial world?
Bringing it back to the listener.
While some analysts, like Reinberg, suggest a patient approach, perhaps waiting for a market dip to secure a better margin of safety, targeting closer to $510 for a potential 14% annual return.
Looking for a better entry point.
Right. The overwhelming consensus remains an overwhelming buy rating from sources like dividend data. It's consistently seen as a high-quality large cap by astute observers like Librarian Capital, with expected mid to high teens total returns mirroring its earnings growth plus its reliably growing dividend.
So the potential return matches the expected earnings growth plus the dividend.
That's the general expectation. It's not just a payment company, it's widely considered a foundational piece of the modern digital economy.
To connect this back to the bigger picture, Mastercard remains a compelling investment with an incredibly long growth runway, stretching far into the future.
That runway theme again.
It's key. Its business model, characterized by operational excellence, an asset-light structure, and strategic adaptability, consistently ranks it among the best businesses in the world. It's a company that has not only built a formidable network fortress, but also possesses the innovation and foresight to continuously expand and defend it in an ever-changing financial landscape. Outro.
So there you have it. We've taken a truly deep dive into Mastercard, revealing not just a transaction processor, but a business built on a remarkably resilient, capital-efficient model.
A real financial fortress.
We've seen its impressive Q2 2025 financial performance, its vast and compelling growth potential in the ongoing global shift towards digital payments, and its proactive, ingenious approach to leveraging, rather than fearing, new technologies like BNPL and stablecoins.
Adapting and thriving.
All of this underpinned by rock-solid financial health and a clear commitment to shareholder value.
And if we connect this to the biggest picture possible, the company's network fortress isn't merely built on static dominance or sheer scale. It's a living, evolving entity built on unwavering consistency, relentless innovation in reducing friction, and a profound, fundamental understanding of how the world truly pays and how it will pay in the future.
It's about more than just today.
It's not just about enabling today's transactions. It's about actively shaping, influencing, and profiting from the very future of global commerce.
Okay, final thought for our listeners. As digital payments become increasingly seamless, integrated, and even invisible within every aspect of our lives,
Which they are.
what new forms of value exchange or even entirely new digital currencies might emerge that could truly challenge or even redefine the very transaction runway that companies like Mastercard are so adept at expanding today?
What's the next disruption?
And how will their deep-seated culture of innovation continue to adapt to what we can't even imagine yet? Perhaps even transforming these nascent concepts into new revenue streams themselves.
Can they keep enabling the future?
Think about that profound question next time you simply tap to pay for your coffee, and consider the intricate, dynamic, and expansive world behind that simple action.